Hey, what's going on YouTube? Welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Lux Algo. Lux Algo has some of the best trading indicators and AI agent for backtesting, used by over 15,000 traders, including myself, and I've covered many of their premium indicators in the past on this channel. And right now, if you sign up to Lux Algo by using my link in the description below, you can get up to 35% off. Keep in mind you can also get 30 days risk-free. So go ahead and check out Lux Algo. I'll put a link to them in the description below. Also make sure to check out the Discord, completely free to join. I'll put a link to it in the description below as well. We're almost at 8,000 members. So thanks to everyone that's in the Discord. Now let's get right into today's video. So today I want to talk about a question that I see all the time. And that question is, can you sell puts without needing collateral? And specifically here, we're talking about cash secured puts. So for those of you that are not familiar with selling puts, let's very quickly go over how it works. So for today's video, I'm going to be using this stock right here, MicroStrategy, ticker symbol MSTR, to show you different examples of what we'll be discussing here today. So keep that in mind. Everything I'm showing you here today is just that, examples. So let's go over to the options here for MicroStrategy. So where can we go to the options? There is this button here on Robinhood that you can click to go to the options for the security that you're on. So let's go ahead and click on this button here. So this will take us to the options for MicroStrategy. And again, today we're focusing on selling puts. So let's first go over to sell here. And then let's go over to puts. Now remember, selling puts is a neutral to bullish strategy. So we want the stock to either trade sideways or go up in price generally. And it's going to be used a lot of the time to collect premiums with the possibility of also having to potentially buy 100 shares of the stock at a predetermined price. So here's how I generally implement selling puts. So the first thing I do is I determine what price I believe the security will be above at expiration. So we need to make sure that we select an appropriate expiration date here. I'm just going to leave it as August 15th. So the first thing I would do here is I would say, what price do I believe MicroStrategy will be above at expiration on August 15th? And so let's say I think MicroStrategy will be above $390, and I'm just making this number up, but let's just say I think it's going to be above $390. So before selling my put at that price, I also need to make sure that I would be okay potentially owning 100 shares of MicroStrategy at that price. So let's say I'm also okay with potentially buying 100 shares of MicroStrategy at $390. Then what I would do here is I would sell a put with that strike price. So where's the $390 strike price? Right here. So this would be the put that I would want to sell then. And so if I select this for selling this put, I'm going to get paid a credit or a premium. How much? You can see that under the price column. So $8.80, and that's per share. But remember, each contract controls 100 shares. So we would multiply this by 100. That means I would get paid $880 to sell this cash secured put. Now in exchange for selling this put, I have to put up collateral. How much? Whatever the strike price is times 100. That means I would have to put up $39,000 in collateral. I would have to have $39,000 to be able to sell this put. And that's where the problem starts to come in. But let me finish explaining selling puts here. And so let's say I did have $39,000. I would put that up as collateral. At expiration, one of two things would happen. Either the share price of the stock would be at the strike price I selected or higher. If that happens, this option I sold would expire worthless. So I would get back my $39,000 in collateral, and I basically made $880. Second thing that would happen at expiration is the share price goes below the strike price I selected. In that case, I would still keep the $880, but now that collateral I put up, that $39,000 I put up, would be used to purchase 100 shares of MicroStrategy at an average cost of $390 per share, which should be okay, because remember, before we even sell this put, we need to make sure that we're okay potentially buying 100 shares at the strike price we selected. And so let's quickly visually take a look at what this looks like. So what I'm going to do is I'm going to go over to OptionStrat now. So I'll put a link to OptionStrat in the description below. This is an options visualization tool. So it allows us to visually see what might happen before we enter an options trade with that trade. So let's go to build, and under income, they do have a cash secured put option here. So let's go to the stock that we're using for today's video, MSTR, MicroStrategy. For our expiration, we just selected August 22nd. Again, the first thing we did was we said, determine what price we believe the stock will be above at expiration. And let's sell a put there, but only if you're okay potentially buying 100 shares at that price. So I said, okay, for me, that's going to be $390. I think MicroStrategy will be above $390 at expiration, and I also would not mind buying 100 shares at $390 if MicroStrategy went down and this didn't expire worthless. So this is what this would visually look like. Again, we would be entering for a premium or a credit, $880 for this example. We'd have to put up $39,000 in collateral. You can see what our max loss is if MicroStrategy would go to $0. Max profit is going to be the credit we received. If you have the premium version of OptionStrat, you'll see the chance of profit. And then we also have our break even here. And so ideally, what would we want to happen here? We would want the put that we sold to expire worthless. That's going to happen if at expiration, the price of the stock is at the strike price we selected or higher. And so we can visually see this on the P&L chart. You can see at expiration, if we're at $390 or higher, we're going to make our max profit of $880. And then if we're below that at expiration, you can kind of see what your profit or loss might be depending on the share price here. Now, again, what is the problem with this? Problem is a lot of people aren't going to have $39,000 to put up in collateral. So what if we don't have that collateral to potentially buy 100 shares, but we still want to sell puts to collect premiums, weekly, bi-weekly, monthly, whatever it might be? How can we do that? And can we do that? So there is one way. So let's go back to Robinhood here, and let me show you how you could potentially do that here. So let's go ahead and we'll actually just leave this here because we're not going to have to modify this. Let's say we can't put up, cash as collateral. We can't put up $39,000 as collateral here. But again, we still want to sell puts. We still want to collect premiums. We're still neutral to bullish on the stock. What can we do instead? Well, if we can't put up cash as collateral, then we will need to put something else up as collateral. And luckily for us, something else we can put up as collateral is actually a put. So instead of selling a put here, we're going to switch to buy. We're still going to sell our put like we normally would, but now we're going to buy a put. And that's actually going to become our collateral. Because remember, buying a put gives us the right, but not the obligation, to sell 100 shares of the stock at the strike price we select on or before the expiration date. So if we sell a put and we're assigned 100 shares, by buying the put, it's going to allow us to sell the 100 shares at the strike price that we select on or before the expiration date. So again, we're still going to sell the put like we normally would. So remember, you should be selling a put at the strike price you believe the stock will be above at expiration. And now we're going to buy a put with a lower strike price. So if I sold a put with a strike price of 390, I would now buy a put with a lower strike. So I'm just going to buy the put right below it at 387.50. So I'm going to go ahead and select that there. And as you can see, Robinhood recognizes this as a put credit spread. And as you can see, we're still going to enter for a credit or a premium here. And if we take a look here, we're still going to put up collateral, but it's not going to be that much. It's going to be $250 only here. And you can see also here from the P&L chart, this is still going to be a neutral to bullish strategy. So let's go over to option strat, and now let's visually take a look at what this would look like here. So I'm going to go into a new tab here for option strat. And then we're going to go to build, and we're going to start with just a regular put here. So again, stock we're using today is MSTR, MicroStrategy. Expiration we selected was August 15th. Again, that's how we want to sell puts. We want to collect premiums. We're still neutral to bullish on the stock. So we would come in and, again, we would determine what price we believe the stock will be above at expiration. So again, let's just say we think it's going to be above 390, so we can sell the put there. But again, we don't have, $39,000 that we can put up as collateral. So what we can do instead is we can buy a put and use that as our collateral. So we're going to go ahead and add buy put here. And then remember, we want to buy a put with a lower strike. So we're going to buy the put at 387.50 here. So again, this is a bull put spread. We're going to enter for a credit or premium. So you're still going to be able to collect those premiums, $90 for this example. Now we got to put up collateral, but it's not going to be as much. It's only going to be, for this example, $250 as compared to $39,000. We see our max loss here, 160. Max profit, again, the credit we received. If you have the premium version of option strat, you can see the chance of profit here, and then our break even here. So here, again, at expiration, the ideal situation would be for the stock price to be at the strike price of the put we sold or higher. So if at expiration we're at 390 or higher, that's where we're going to make our max profit. And then again, from this P&L chart, you can kind of visually see what your profit or loss might be depending on the share price or the date here. So we're still able to enter for a credit. We're still entering a strategy that's neutral to bullish here. We're still selling puts. But now instead of having to put up $39,000 in collateral, we don't have to put up that much. And so the difference here, right, is of course here, you're not going to have to buy 100 shares of the stock if something goes wrong, but instead you'll just lose the collateral that you put up here. So, if we receive $90 in premium and we put $250 as collateral and this thing goes the wrong way, we would lose $160, right? $250 minus the premium, $160. So here you'd lose the money you put up. When selling puts, of course, you would be assigned 100 shares, and then you could do with that whatever you want. So this is a potential way to sell puts without having to put up, the collateral that you normally would need to potentially buy 100 shares of the stock. So if you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.